Let's bring in Henry McVey, Chief Investment Officer of Balance Sheet at KKR. It's good to see you again. Welcome.
Thanks for having me.
I wish we were here to talk about better. I mean, in some ways it is good news, but in other ways it's not. You know, and your point about how this is a structural problem means that should the Fed even be hiking rates to try to fix the labor market?
I think there are a couple points here. One is the Fed uses their interest rates as a blunt instrument to slow cyclical things like housing. But if you think today, the Fed has raised rates to almost 5%, and the unemployment rate has gone down.
It's crazy.
So what's happening there? So what we see in the U.S. is lower participation. A lot of people 55 and older exiting the workforce, and ultimately slower immigration. But it's not just a U.S. phenomenon. I mean, this is happening in Europe. China's population is contracting. In Japan, they've done a lot in terms of bringing females into the workforce. But overall, it's like we're hitting a wall a bit on the demographic story, and that's been exacerbated by COVID and what happened there.
Kind of brought it forward, maybe. And if that's the case, you would never say, well, the central bank should try to fix that, right? I mean, all of this would argue, and the things you talk about, so all of us from personal experience, the need for childcare, the need to help with care for older people that people might be leaving the workforce to take care of their parents, for instance. Those are big structural problems that require like a lot of private and public resources to fix. So it doesn't seem like to me that would involve the central bank at all.
Well, I think there's monetary policy, and ultimately what that means is we're going to have a higher resting heart rate for where short rates are. And I think I think so, because I think they're going to have to, even though they can slow the goods part of the economy, which is happening right now, it's harder to do services. The single biggest input in services is labor. Second is, okay, how do you fix this problem? One is we've been investing around fertility clinics in Europe. Second is, to your point, childcare. Childcare in the U.S. is 4 times more expensive than it is in any other part of the world. Wow. The third thing is you have to get more women working, and that ultimately gets back to childcare and how you run your home, and everybody's got a different story there. And then the final thing is you need to get more people 55 and older staying in the workforce. And I'd say the U.S., when you look at the COVID policy, the U.S. was the one country that really said, okay, we're going to allow layoffs, but then we're going to go direct to the consumer with stimulus. Europe actually put that stimulus in the hands of the employers, and their unemployment rate went up less than 100 basis points. Same thing in Japan. Wow. The U.S. unemployment rate went up 900 basis points, and we're fighting to get people back in the workforce.
So basically, we kind of compounded the error because we paid people, in essence, not to work, not intentionally, but in Europe and Japan, they paid the companies to keep workers
and they kept people associated with their companies.
Yes.
What do people want over time? They want to have a job. They want to work. We've been spending a lot of time at KKR around employee ownership. How do you get people engaged so that they want to stay there? We're spending a lot of time also around automation. How can you take processes and make them more higher value added through technology?
Right, because if you don't have enough workers, at some point you have to then add the bots, add AI, whatever. So are you investing for that? So again, to boil this down for investors, other than thinking through the fact that rates have to be higher for longer to keep wage gains down, what are the kind of places where, hey, these could be secular growth stories for the next 10, 15 years?
I think there's a ton that's going to go around worker retraining. That's been a huge area of investment for KKR. Fertility, we mentioned. Software companies that make supply chains more efficient. Ultimately, the labor arbitrage between Asia and the U.S. has narrowed. So as we bring things back to the United States, how do you invest around real estate? How do you invest around infrastructure? Sure. Ultimately, warehouses. That's been a big area of focus for us. But I think the most important thing we can do, we own over 200 companies globally, is what we're doing to engage our employees and letting them be owners in the business. What you see is the attrition goes down, satisfaction goes up, and you end up with a better outcome for everybody.
So just to make sure everyone's following these dots, you guys as the investor in all these different companies all around the world have an interest in making sure you have good workforces in order to get good performance, right? And the best way to do that is to try to make those workers basically shareholders of the company as well. Yeah. And if you're doing that at such a scale, I mean, is that really incentivize people enough, you think?
I do. I think if you look at KKR, we have, when you look at our 200 portfolio companies, we have over almost 1 million employees to our portfolio companies.
Wow.
So it's a major business. So how you treat them, how you work with them, ultimately leads to better outcomes. And if we're in the right verticals for growth, you can drive different outcomes. And so I think there's definitely a caution in the piece that we put out, but there's also an optimistic story, which is you need more worker retraining, you need more engagement, and ultimately you need to be in the verticals where people feel engaged to be back in the workforce.
What if someone like me came and said, you know what, I think we're just a couple months away from a big downturn, Henry, and this labor market is going to look very different? I mean, is that still a possibility here?
I think the data is bearing out, and you're seeing this in the government data, is that employers are not going to shed employees the way they did in the past. The time that it takes to get a worker, particularly in the services industry, is a lot longer. And so what you're seeing is less attrition. The workers may want to to leave because they may want to leave because they see a better opportunity.
But I
think that's going to be less of the case from the employers.
I hope you're. I mean, other than the implications for the Fed, I hope you're right. I mean, that would be a massive balance of power shift. Can you imagine? Well, you're seeing it, I guess. Yeah.
Yeah, I think there's a secular change going on, and the piece is worth taking a look. So
Absolutely.
Thanks for spending the time with us.
Thank you for coming, Henry McVey. Good to see you again. Really appreciate it with KKR, as I mentioned.